just went through with the previous trade, with that first trade that you had in there when you got that first contract. You have the bullish types of situations. Now what do? You set a profit target. Again, if you're at 77.67 when you entered, 3 points plus that means at 80.67 you then would, take your profit, have a limit order in place, and take a profit on perhaps just one contract, but at least take a profit somewhere in there. And that occurred, I don't have the exact price in here, but somewhere right in there where you probably would have caught that early move there on a limit order, and you would have then been out. It's kind of like adding on, lightening up, adding on, lightening up. It's the whole process you'll do to manage the profits as you see them move to the upper end of the range and move higher. Now we're going to take a look. We've looked at the first half kind of the situation, and we want to take a look now at what would happen as we continue from March the 1st to today. And I want to focus a little bit towards the end to show you a little bit about the current situation and where we are today in the market with the U.S. dollar index. We're going to skip over into the later period. Now we have the later period from roughly the end of February all the way to the current time, and talking about the same kind of signals that we're going to be looking at as we looked at on that first screen. When you look at this screen, of course, it may not show it exactly, but this is a situation where that trend, long-term trend, is continuing and moving on higher. When we look at that trend, we know that in hindsight, that trend is moving up. We don't know that as we're, looking at it at the left side of the screen. We don't know that there's going to be a long-term trend, but we are going to assume that we're going to ride the profits. We're going to ride the trend as much as we can until it tells us otherwise. Now, another possibility that you might look at for setting, a point at which to exit and stop, you could just go below the previous lows and move them up whenever you see a move above that signifies a move above a previous low and kind of moves on up from there. So that's another possibility for setting it rather than using the predicted lows, but that's more based on the traditional technical analysis, and it's also can be quite far from where the market is. When the market gets moving to the higher side, you don't want to lose that much profit a lot of times, so that's why you want to keep that trailing stop moving right with you. Okay, in this case now we are in a situation, and as I say, on March 18th, where we had a predicted high here of, let's see, 80.15. That means we're going to be a buyer at 80.65. If we buy at 80.65 and position ourselves, that's about somewhere right in the vicinity right here, and we're going to position ourselves, and we get another possibility for a little run to the upside. Now, if we did that, a profit target would be at 83.65, and 83.65 is, if I have my lines in here about correctly, somewhere way up in this vicinity right here. Obviously, that profit target did not come into play there. You may have to adjust, adapt, as an active trader, because you may not, or quite often will not hit that profit target. When you do, you say thank you, put it in your pocket, but when you don't, you have to react and take some other kind of action. So in this case, again, you have the same thing that you faced before. Do you want to just kind of, lighten up, take kind of a smaller position, maybe that one remaining contract or whatever it is that you are trading, or do you even want to go short as the market has this little short-term decline to the downside? But as is quite often the case, when the markets are going in one direction for a little while, you will see that all of a sudden things start to change. We have the predicted differences start to turn up. The predicted moving average that we have here, that blue line that we're talking about, that starts to move to the upside and confirms a long position. Some bullish signals that come together and suggest that maybe we should be looking at another long position. The U.S. dollar index was on the right track. It was on the trend, and they were correct. And so maybe you get back on board. So in this case, on April 15th, right in the middle of our chart right here, we had a predicted high there of 80.67. So that makes us a buyer at 81.17. Again, we're using that 50-point little margin there to kind of protect against the jabs and so forth. So that 81.17 is going to come in somewhere right in there, give us a long position. And again, as before, now we have to set a profit target, in this case 81.17 plus our 3 points, our 3 full points that we're looking at. We're going to be setting a profit target at 84.17. Again, I'm eyeballing this, but it's going to be somewhere in the vicinity right there, 84.17, and you have your 3 points. The market moved up without threatening really your stop points based upon your predicted lows. So you have moved up, and you would have added another contract if you, or you may have reestablished a long position, depending upon what you did, before with what was going on. Now you also have a situation where maybe you didn't have it that way. Maybe you didn't take the profit target approach, and all of a sudden you have a situation where you have a kind of a downdraft, kind of a one-day downdraft, a shot down, and you had your predicted low in place at 84.35 minus your 50 points, and that was 83.85, and bang, you're hit, you're out, and so you have to kind of reevaluate. If you still have your one contract that you're writing, you're still writing the trend. That's the primary trend, and you're still with it. Again, it depends on how you want to play it and what kind of position you have. But the same kind of thing then does apply as we did before, where we had our predicted high here, where we could then jump on board the trend and get 84.77 was a predicted high, and so at 85.27 we would be in a position to be able to trade another long position. Now, when we get to this level, we have another consideration that we have to think about, and we have to talk about kind of these dips. Number one, we're getting close to a previous high. In March 2009, the high of the U.S. dollar index was around 89. We're not that far away. So the question is, if we're getting that close to it, do we want to establish a position in which we then, our profit target might be a moot point, because you can expect as it approaches a previous high, there's going to be resistance. There's going to be potentially a pause. There's going to be some trading back and forth and chopping back and forth. And it's like, why do you want to be exposed to that? Because sometimes when you have exposure to the market, you're vulnerable to, let's say, some sudden move that occurs because of a news development. In the case of like the stock indexes, like we saw back on May 6th, where you had the flash crash, you never know what's going to happen in the market. So sometimes it's better to take what you can and exit, be out of the market, rather than have that exposure. But again, that may be a little bit more about the way you trade. Maybe that would be a different strategy for you. The other thing that we have entered into is that we have a period of time in here where, as you know what happened in the stock market from the 1st of May and thereabouts all the way through here, we have a period of time in here where the range gets pretty wicked, and the volatility was pretty wild, and some very sharp up days, some sharp down days. Again, in those kind of circumstances, you could be right. You could make big bucks.